Hello, Warriors. How's everyone doing? AJ, welcome to F.A.C.E, Bran, Alexander, everybody. Strong dollar again today. Metals taking it on the chin. Everyone doing okay?
Morning,
How's
Dale.
the team?
Morning,
How's the
everybody.
team doing? All right. Hey, Kman, what do you make of dollar strength continuing?
Look at yields, my friend. It's they're pushing. So I guess the correlation algos are having a ball. It does continue, and I mentioned your 390 this morning on the flow show too. So I borrowed that ID from you, if you don't mind.
Oh no, I don't mind.
Yeah.
Imitation's the highest form of flattery.
Wow, there you go.
Have
Okay,
you ever
guys,
heard that?
pin that one to the top end of your screen. No, so yeah, it's going, and for the time being, we can only say it's real because they are continuing to go. Negotiations continue, liquidity continues to be talked about. There's a lot of talking about. I'm not sure how much big players are really involved in this. Been reading some stuff here and there that short positions in some of the euro have been increased, but then real money would still be sitting long. People are starting to get long yen again. I can see that because some of the yen process might have been a little bit over ecstatic there. If you look at the breaks of recent highs in sterling, yen, euro, yen, both the yen have been undone, or could falter, let's put it that way. So there's still a bit going for the dollar, and it looks a bit concentrated now, because if you even see like the very high yielders, like the MEX are suffering a little bit. So that's keeping all the dollars a bit underpinned right now, but it's all a yield story, right?
Yeah. And so if that formation manifests 390, it's not done yet. So
yeah, and
right.
if you look at the speed of it, yesterday we were trading 365. Today we are trading 375 on the 10s, and
yeah, good point. Velocity.
It's the case of perhaps at the end of the week we're there if it continues at this speed.
Are the bears and S&Ps going to get a chance to sell it at 4,300, or is the market not going to accommodate them, and that we just roll over from here? I mean, 4,200. The one thought that comes to my mind is 4,200 was such a big level. Why are we trading 41.83 this morning?
Yeah, so that means that your big levels have only made for shorts to cut their shorts probably, and not for longs to want to push it right now.
Yeah.
I think the fact we haven't reached a debt ceiling, a conclusive debt ceiling resolution is, I reckon, from here going to keep the equity markets a little bit more on their toes, and it may not be as straightforward of going to 4,300 as people expect as quickly. If you get a really good solution to it, then that may still be the case for it to go and do another. What is it? That's 2.5% from where we are.
Was there any news, because yesterday afternoon the S&Ps were up around 9-10 handles after Biden and McCarthy came out of their meeting, said that their talks were constructive. Has there been any news that talks
not since on that front? No.
Okay.
Not since. Risk is doing slightly worse today. Yen has stopped following yields. So that's and if you look at the commodity sphere, it's again quite a bit lower. And as you said at the beginning of the show, metals are giving in. Silver broken. Gold is trading average, very average. So for
looks
the time
like it
being,
wants 1920.
yeah,
which
absolutely.
was a big,
That's we have the same line there. That is a very, very possible target for this move.
Okay. I was going to ask Stel, because I was thinking about what he said, what Yellen had said, that they could handle a default. Are you around, Stel?
Am I wrong about what? About what I said yesterday?
No, not wrong. I was just thinking about it. See how we're also defensive. Anyway, that Yellen.
You have a great guest to talk to us about this today. He's absolutely fantastic, and I can't wait.
Yeah. So, but I'm wondering. I thought about it. That now she's saying they could manage the default.
Yeah.
When a month ago she was saying it's the end of the world. So it almost sounds like strategy. She used the pressure that it's the end of the world when she thought that pressure might get something done. And maybe she doesn't think anything's going to get done. So she's prepping the market that it's not going to be as big of a deal as people thought. And maybe that takes away some of the leverage of people that want default. So anyway, she's talking out of, within 30 days, she's talking out of both sides of her mouth.
She's talking out of something else, but I'm not going to say it.
Yeah.
Seriously, these people, I mean, yeah.
And go ahead.
No. I was just going to say they're going to say both sides, argue for both sides, whatever fits the narrative at the time. So I'm not gonna put too much.
Not to mention the elephant in the room, that all these arguments have zero meaning, because if there was even remotely the intent to do the right thing, the discussion should not have been about negotiating, increasing the debt ceiling, but finding a viable way forward so they don't need to keep increasing the debt ceiling indefinitely.
Okay.
That's the only conversation that's worth really having.
All right. So Ishan, we talked about this 1920 level is going to be very important in gold. And Kay, I was thinking about you yesterday when, we were talking last week how China was making overtures that they want to, have things, have better relationships. And then what they do this week, they ban Micron chips.
Yeah, and they just reconfirmed to want to have better relationship with Russia this morning.
Oh, okay. See, so I mean, anyway, it's just like everyone has like everyone is bipolar. We have bipolar nations where well, I guess there's a diplomatic front, which is bullshit, and then there's the other front, which is about money and security, and that's what's real.
Yeah, so. And there's supposed to be a Chinese representative coming to the States this week, isn't there? The trade one of the trade ministers. I wonder what that's going to give. I reckon not a lot. But what is interesting there as well on China, if we stick to that, is that, and Ryan said it this morning as well on the Flow Show, is that the PBOC is fixing the dollar-yuan higher again, and that's seemingly giving the market the green light to continue to press on the Chinese yuan this morning.
Well, this kind of looks like the breakout we had in 10-year yields too, around the same time.
Yep.
And this formation is pretty easy to measure. It's like 30 handles, so that gives you 730 back to these highs.
I don't know whether
breakouts
I'll take that. I don't know whether we can reach it quickly, but for sure it is holding 7 pretty strongly. So for people being short yuan, for instance, it's let's call it an easy level. If it goes back below and it stays below, then it's party is over, right? But if it stays above, then anything's possible.
Yeah. Okay. And what's going on with you, Ryan? So you're on board this US dollar yuan trade on the long side.
Yeah. Okay. Yeah. Yes, mate.
You've been for a while, I think, haven't you?
692s.
Yeah. All right. Looking good. You have to, what are your targets?
Well, I'll take your 730. I'll bite your hand off for that. But I think if we can get above we got a bit of a level 709 to 712. If we can get above that, I think if we get to the 720s, we'll hear a bit more jaw boning coming out of China, depending on the speed of any rally to there. They've sent out a few ducks, shall we say, as warnings, but it's nothing strong yet. And as Kay mentioned, they're fixing higher. If they start keeping the fixes down while it's still rallying, that's another signal that they're closely monitoring things.
Okay. Steve, so you're watching metals for a possible breakdown and a continuation correction. I have some pretty good confluence at 22. There you see the 200 days coming in, but what's interesting is that on the weekly,
silver is breaking down today from the trend line.
I already said that. What I'd like to know is
that acted as support. So the next downside target is at
22,
roughly 22.35, 22.40. Yeah, and then we have the 200 DMA a little bit lower, exactly at 22.
Yeah, and then on the weekly, it confirms what you see on the daily, because you have the 50 week at 22, 200 day at 22, 50 week at 22, and the 200 week isn't that far away either. It's 2170. So lot different time frame MAs pointing towards the same area.
Yeah, it is likely. It's a squeeze. It is a squeeze. People that were very late to the party are getting squeezed out.
You ready to fade the dollar yet?
No, not yet. I think it's still unfolding, and I'm hoping it's going to last a little bit longer. I mean, the more it lasts, the better the levels we're going to get to short. I'm not changing my mind about shorting the dollar, but I'm not going to jump the gun without having any signal that the rebound is over.
Okay. And here against GLT, we're coming in lower again this morning. Don't you think we're going to make new lows here?
Technically speaking, it's definitely not unlikely. Although I have to reiterate here that there are several factors that are in play, fundamentally speaking, that can destroy this attempt literally overnight.
Yeah, all the shorts.
I don't only mean that. I mean any kind of scare that comes, again, let's say banking system, let's say having to do with growth or an upcoming recession, will immediately get bonds bid, right?
Yeah. Looks like new lows, confirmed low on the weekly. Hasn't done anything right. I wanted to give this the benefit of the doubt that it was a reversal formation, but price is truth.
Price is always truth. I agree with you.
Gold silver ratio again, kind of taken off again. So, that's why gold.
You called it.
Yeah, the gold silver ratio has had a very nice rebound from the 77.5 low to 85 almost now. And, we've kept oscillating in a range, let's say between 75 and 95 for quite some time now. Doesn't look like the current rebound is over, which makes sense because it doesn't look like the pullback that we're seeing in the metals is over, right? So we should see the gold silver ratio remaining well bid as long as we still have metals correcting to the downside.
Gold silver ratio correlates pretty good with the dollar. Going up, strong dollar, going down, weak dollar.
Yeah, because gold silver ratio correlates quite nicely with the performance of metals as well.
Oh, well, they are metals, but a lot of people wouldn't think that it would with the dollar. And anyway, just something that I learned recently.
I mean, the performance of the metals correlates with the dollar, and since the gold silver ratio, although if somebody didn't know about it, would have assumed that might have been uncorrelated to the performance of the metals. It is not uncorrelated. Metals performing badly in the vast majority of the cases means that the gold-silver ratio is moving to the upside. Metals performing well usually means the gold-silver ratio is moving to the downside. So, since the gold-silver ratio is more or less directional, and the performance of metals is at a big extent related to the performance of the dollar, because we're talking now about metals denominated in dollars, right? So it makes sense that the gold-silver ratio and the dollar have a correlation with each other.
Okay. Be careful about pressing it down here. I wouldn't be trading the short side now. Your goal signal was 2,000. I wouldn't be doing it $40 lower. So just in case, because dollar could come off from here. You got a little double top here. Kman was talking about the yen strength slowing down, so you could get a pop in the metals again because of the gold silver ratio. You want to play a pop in the metals, buy gold, not silver. Look at the two candles. See this candle? Nice candle. See this candle? It's okay. But the technical damage is worse in silver than gold right now. So if you want to scalp the metals from the long side, that would be my preferred long. Why don't we bring anyone else have anything, any news that you guys are looking forward to, or is it all about just watching the news and seeing if McCarthy and Biden are smiling or scowling at each other?
Yeah, just bouncing between the headlines from there. We got the S&P Global PMIs for the US, the flash number, mixed results around the rest of the world, some up, some down, some better, some worse. It's part and parcel of what we've been seeing, Dale. 1 month up, 1 month down. That's the way economies are going to be, I think, for the foreseeable.
So does anyone think that China, the Chinese make phones too, don't they?
Yep.
I mean, they make, they can make anything that they've stolen from us, right? So, and I know Apple's still a good company, and in fact, I'm underwater on this position, but God, that would be taking down an icon if they did something like that.
Whoa! You're underwater in this position. Were you buying Apple up here?
No, I've been buying puts from here.
Oh,
and then
okay.
I had to live, and then earnings came in, and wiped away about 30% of option premium, and I bought a little more. I'm not going to do anything until we're back inside this formation.
You faded it before earnings. Okay, got it.
Oh yeah. So it was fun earnings report day. So I'm thinking that if China really wanted to have an impact, and I heard someone saying this is just beginning, because China, it's security concerns over economic concerns, and we have blocked them from getting a lot of stuff they need. But if they really wanted to hurt America, why don't they just have their consumers buy other kinds of phones besides Apple? And that would be take an icon down.
Is Apple the biggest phone out in China? I don't think so.
It isn't.
They've got loads of their own gear.
Yeah, so maybe it wouldn't even make a difference unless they generate a lot of income from being a manufacturing base for Apple. But I would be surprised that they start, taking knocks at other U.S. corporations. Micron was not a small deal, especially since they say they need chips, right? So, anyway, interesting development there. And I want to know now what Blake's thinking about this strong dollar and what else he's really focused on. He's doing anything with MEX.
Well, I'm glad you asked. And good morning, everybody. How's everybody doing today?
Good morning, Blake.
Good morning.
Morning. This is like, it seems like the first day in a while that things aren't as quiet in the morning. As I've, when I get up and, Dale and I get up here in North American trade, it's like, oh my gosh, I feel like I should just sleep in another hour because nothing's happening. But today seems like the first day that we've have a little bit of activity, and or a little bit of volatility. Let's just put it that way. One of the big things on my screen is this, the Nikkei. And, we've been watching this Nikkei rally to highs that we haven't seen since the 1990s. And you're seeing a big reversal today. Now, I don't know how we're going to end up today, but we have a bearish engulfing developing. So that suggests to me that a lot of people were, FOMOing this into this market. And we're seeing a bit of reversal here. Now that does have my attention because it does influence a lot of the yen pairs. So if you're looking at the dollar yen, I've been real hesitant about being on the short side of the dollar yen. I played it long through the 138 level. I was short a couple of yen pairs, got stopped out and closed them out at the end, or not at the end, like middle of last week. And I took some losses, and I turned around, went long the dollar yen, and and it's been hovering above like the breakout point above 138. I know we could probably talk endlessly about the yen and what's moving it, and probably yields, which, by the way, I know Kman said something about yields a little earlier, but looking at yields continuing to break out. We just completed a bull flag pattern that had been on my screen for like ages, well, like the last couple of weeks. We just completed that bull flagged pattern today. We're nearing the 618 retracement. So, if you put two and two together, you got the Nikkei that looks a little reversal-ish. You got yields that may top out somewhere around here. Then that, I start looking at these yen pairs, and I start, thinking maybe we might have some setups developing, and you see new highs in price overnight to the 127% extension. Relative strength is divergent. So now all we need is, some data to really suggest that yields might come back down again, or maybe something that might knock down the dollar. So, Dale, this is a roundabout way of me answering about the dollar here. But what I want to look at is the data that's going to be released today. We had PMIs that came out in the UK and the Eurozone. So what did you guys on the Flow Show make of all the PMIs that came out this morning?
Just a bit mixed. Japan, had a really good reading, but again, we've seen, the sector divergence. I think France, they had a poor performance. Germany was a bit better. It's all a bit meh. Do you know what I mean? There's no one going gangbusters, and one month you get a strong reading, the next month it comes off a couple of ticks. I think, as I say, that's par for the course of what we're seeing in economies. Rolling around the plus minus recession mark.
Yeah, it's interesting. All the manufacturing PMIs, UK, Eurozone, all pretty negative. And you had French services PMIs came in a little worse than expected too. It's interesting. Yeah. I wasn't even looking at that data earlier. But you have, the services PMIs have been fairly strong. Japan's numbers are strong, which is interesting, right? You have, maybe the Japan exceptionalism coming, right? But one of the things that's happening today, a little bit later this morning, here in the US, is we will have. Now, this isn't ISM PMIs. This is going to be S&P PMIs, and they're going to be out in approximately 1 hour and 15 minutes. So we're going to be watching those numbers, especially in the ForexAnalytix community. They'll be happening as we have the Morning Edge show that will be on for the ForexAnalytix crew. But that data is going to be out a little bit later. So keeping an eye on that. Obviously we're watching the debt ceiling. And I want to ask you guys really quick, because we look at the dollar. The dollar continues to hold up pretty well. I still think that the risk is that the dollar can scream higher, especially if we get some sort of debt ceiling resolution. I'm a little worried that we're just going to kick the can down the road. I think that's going to be like the the extent of it is we're just running out of time, and they're going to say, like, we just have to push it off for a couple of months and deal with it a couple of months from now. I'm thinking that that's going to end up being, right at the 11th hour is just, extending the date out. But what are your thoughts, guys, on how the debt ceiling is going to play out, and how would you play it? So in other words, if we had the debt ceiling talks, we came to some sort of resolution, how do you think it's going to play out? So Ryan, what are your thoughts there?
I think probably one of the easiest markets to look at would probably be stocks, because I think that will probably be your kicker for rallying the S&P through your 42s properly, if it hasn't happened by then.
Yeah.
That might be your cleanest trade. Dollar, I don't know. Dollar's looking stronger on the back of yields. Does that all reverse if there's a 2-year deal that comes through that, or does it strengthen because the risk has come out of it? It's really messy for me what to do in terms of sitting here now and picking a trade, because I really don't know. I think before yesterday evening and the comments from Biden and the likes, I thought we might be heading towards or close a chance of hitting a default and seeing some shutdowns. But the way they were talking, they're going to perhaps try and avoid that. But we could get comments this afternoon and that flips 180 again. So it's hard for me to pick a side now and stick with that trade, if you like.
And I'm hearing more and more analysts actually cite the fact that, it's not the fact that they're more and more analysts are leaning into the debt ceiling if it's raised, and the market is going to be faced with and plagued with a lot of issues, and you probably want to be selling the rally that any rally that's produced, you want to sell into it and you want to get short into that. Which I've always been in the camp that, you raise the debt ceiling. They're not finding, as Steve pointed out a little bit earlier, they're not addressing the issue and they're not getting to the root cause of the problem. We are going to be faced with a slowing economy, high rates, a Fed that's not going to budge, and at least not near term, and until inflation, is proves it's contained. The Fed's not going to do anything. So any spike higher you see in the S&P, for me, it's anywhere near 4,300 I'm selling into. If we could get up there, I think Kman, you raised a good point today. I don't even know if we're going to be able to get up there. So, but I am going to look to sell a new high. But I don't even know if we're going to get that here in the next week.
You say a slowing economy, but if the PMI comes out later on, we're expecting 50 on manufacturing. If that comes out at 55 and the services comes out at 55, then the market flips, and all of a sudden the US economy is doing great, and that's what we're dealing with at the moment. We're flipping between data points, so you can't hold a view. You can't hold a view for more than 5 minutes because one bit of data, and then suddenly it's all flipped around. But
I know. I hear you. I believe the higher that we have, I mean, the longer we keep rates at this constrictive level, and I know the world as it normalizes will be able to deal with Fed funds rate at 5%, 4%, 3.5%, 5.5%, whatever it is. But it's the pace that the Fed raised rates that is going to cause a shock in the U.S. economy at some point, and I believe that is coming up soon. So anyway, those are just my initial thoughts here. By the way, I don't
disagree with that either. But we need to get over this debt ceiling hump before the market goes back to really trading the Fed and the economy and stuff.
Yeah. We have some Canadian data coming out. Let me, where is the see if it shows up here. And by the way, we do have the RBNZ later today. So just pay, if you guys have any Kiwi exposure, just keep that in mind. I think some the raw materials price index and the IPPI is coming out of Canada.
Better than expected.
Did come in better than expected. And what's interesting about the dollar CAD, just a little bit of heads up here, we tried to break out of this consolidation, this triangle that we've been noting for literally like since the end of last week. We finally broke out, and it's not going to be a good thing if we just turn around and reverse that. So anyway, I believe we have Joseph Wang here. You guys are in for a really big treat. Dale, I think, has Joseph here on such a great point. But I want to say thanks, team, for being here. Kman, Ryan, Steve, Stelios, and Dale. I hope you have a great interview with Joseph. Is he here, by the way?
He is, yes.
Okay, great.
Hi, I'm here.
Hey, Joseph. How are you?
Hey, Blake. Good to hear from you, and great to be here. Thanks for inviting me again, Dale.
Oh, what a great time to, you know what, people say that. It's always a good time to talk to you, Joseph. So
he's like literally one of the nicest people in the financial markets. I swear, Joseph. So thanks for being here. I'm gonna pass you guys on over, and I have a great interview. So
the nicest and the meanest guys get together for an interview, right? Anyway,
we're all pretty nice.
So Joseph, why don't we just talk? I don't know if you want to use the camera or not. It's your choice, no big deal. All right, we could be talking heads this morning. So last time we talked, I want to, acknowledge you were bullish risk. You like the S&Ps, and we've had a tremendous run. Nice call on that. And you thought we'd have a dollar rally as well, and that's starting to come into play now.
I was wrong on that, Dale, but you were absolutely right that we'd have to have the Euro rally a little bit before we go back down, and you totally nailed that. So nice job.
Okay, all right, but I mean now though, this action, it does look like the Euro is starting to head down. That it finally completed, and I think your targets are viable now. You were talking about maybe seeing the Euro at parity. And one of the reasons was you really think that, we want this war, and that too is coming true. There's escalation there in Ukraine. We agreed to send the jets, and the jets, they remind me of a West Side Story. And now Russia is positioning bombers, nuclear bombers in Belarus. So you still feel like the U.S. is pushing us, America's pushing us into being possibly escalating this from just being a proxy war to being more of a direct conflict between Russia and the U.S.?
What I read in the news is that the U.S. is now giving fighter jets to Ukraine.
Yeah.
And I think that's very dangerous because it seems like there's a possibility that the Ukraine Army may use that to attack Russia, and that's significant escalation. And of course, they promised that they won't do that, or the White House made them promise that they won't do that. But they're in a pretty desperate situation right now. So when you are in a desperate situation, I think all bets are off. So I think the U.S. is definitely playing with fire, and maybe they want an escalation. I don't know. It does seem like they've been pushing for war for some time. We have all these people who come and step in, even the Chinese come and step in and try to broker peace. But the reporting suggests that that's not acceptable to Washington. So that's something
So that's in the background with all the other, noise, data noise, and debt ceiling noise. And do you believe, like everyone else, Joseph, that they will get a deal done? Or do you think it could extend past the default date, where it's going to take longer than the deadline to get something done?
So I don't really care about the debt ceiling, and that's because the most serious part of the debt ceiling, a default on U.S. Treasury debt, is basically off the table. Now, if the U.S. government were to default on treasuries, that would be very, I think, very highly volatile for the markets because you don't really know how investors will handle it. You have a lot of investors who will hold treasuries who will be defaulted upon, and you don't know if they'll be forced to sell or what they'll do with it. In the same way, you have a lot of people who lend against treasuries as collateral, and you don't really know if the lenders will still be willing to accept defaulted treasuries as collateral. I suspect that they will, but you just don't know. There's a lot of uncertainty there. So that's where I think of that's what I think of as the biggest impact on default be on the markets. But we also know through through a congressional subpoena that in the event that there's a debt ceiling that can't be resolved, the Fed has a plan B, and what they'll do is they'll prioritize payments. And Janet Yellen has also, basically nodded to this as well. So if there is a default, what would happen is that the tax receipts the US government is receiving will first go to pay down Treasury interest, the principal will be rolled over, and then someone else will not get paid. We don't know who that someone else is. I think logically, obviously, they're going to prioritize Social Security as well, veterans payments as well. It'll probably be, the federal government spends tons and tons of money. So it's probably going to be some kind of big corporation or contractor that is able to take the hit and not as politically sensitive. So at the end of the day, I think if we do go into a prolonged debt ceiling, what will happen is that maybe you'll have Lockheed Martin or someone not get their payments until the debt ceiling gets resolved, but ultimately they'll get paid. So it's more of a timing issue. When I think of the debt ceiling, the biggest impact, I think, is what it takes to get a debt ceiling resolved. So historically, sometimes that could take significant spending cuts. And if that's the case again, then you could have a downside risks for growth going forward, which might be a good thing because the Fed is trying to get inflation under control. And to be perfectly honest, we're spending about, say, 5, 6, 7% of GDP in deficit spending, and that's really high for a non-wartime economy. So I think in the medium term, it would be good to have some spending cuts.
Okay, I remember showing this chart to you, and you could tell that I was considering long positions because it's called a ascending triangle. This is a proxy for 20-year treasuries, TLT. And you didn't, the only thing you said was, all right? Which, I know what that means, And so, I didn't buy them. Thank you. So that meant that you were actually expecting this. Now, I don't know what you think, but I think there's a chance that 20-year treasury yields make a new high here. This low that we had in October was confirmed, momentum and price confirmed. And to me, it looks like they're breaking down.
I totally agree with you. I totally agree with you. So I'm still bearish on rates. So yields go higher. I think that the 10-year should be trading above 4%, I would think, by the end of the year. So I think of this in a couple ways. First, of course, is that I think the market still hasn't fully processed that perhaps the Fed is really more serious about keeping rates higher for longer than expected, and also that there are a lot of structural components that are keeping inflation high. One could be potential escalation of the war, as we talked about. And two, it could just be, we have this structural labor shortage that's not going away. It's baked in the cake. We had smaller families in the 80s, and we see this across the world, really. And another factor, and the way that I look at any financial asset is just from the perspective of supply and demand. And the expectation based upon from the Treasury's projections is that we're going to have net issuance of Treasury securities between 1.5 to 2 trillion every year for basically forever.
Now, who's going to buy them?
Yeah, people will buy them. It's just that at what price? You just can't print, a couple $1 trillion in treasuries every year and expect rates to stay really low.
Doesn't that crowd out everything? And when you look across the bond spectrum, Joseph, corporate and junk are holding up better than sovereigns. Is there a message in that?
Well, there could be. I'm not sure. I would think that.
The sovereigns were best of breed. The for a long time. That's where that was the go-to market. And the weird action we're even seeing in the treasury bill market, where people don't even want to go out 3 months. They all want to be in 1 month bills.
I'd be cautious about that. That's really just a function of money market funds being very, very conservative. So the big investors in that space are super conservative. When you put money in a money market fund, you expect it to be as safe as a deposit at a bank. So what they're doing is that they're just strategically avoiding any possibility of default, because in the event there's a default, they really don't want that to show up on their books. But I think just a bigger, let's say 10-year macro view, I think what we're seeing in the world is what happens, periodically throughout history, in that the problem is that the problems are not coming in from the private sector like they did, let's say in 2008, when we had a big financial crisis in the private sector. The problems are coming from the public sector, where we really have tremendous mismanagement of our public resources. And so if that's the scenario we're in, and this happens all throughout history, then I think it makes sense for investors to seek refuge out of public sector liability, so out of the debt. So it's kind of a shift. This is like a 10-year thing, more out of the debt market as a flight to safety, and more into things like the private sector assets. And you see this in other countries that are.
You mean like Apple? Like Apple?
Yes, like Apple. Look at Argentina stock market, for example. It's like going parabolic, because people don't look at the public sector. They think it's not good, mismanaged, and so they put money elsewhere, out of the public sector. Now, this is just like a big picture 10-year thing. It's not something that's happening right away, but that's how I look at this.
I read at the Fed guy that pretty much this crisis is contained that we had with these banks. But I have to ask you, the cockroach theory, I think all banks are loaded up on paper that was bonds at 2% 10-year and lowest rate since the last American Civil War. And wouldn't a break, you agree that we could see higher yields? Isn't that going to put more pressure on these banks and take a hit to their assets if they have to mark them to market?
So you're totally right. So on the asset side, some banks are going to be underwater because they made a loan fixed rate and now rates are higher. But when you're thinking about a bank, it's not just about assets, but liabilities as well. So if you want to think that they're, let's say, have a poor net worth or potentially insolvent, you have to look at the asset side, but you also have to look at the liability side. Now, broadly speaking, most banks, their liabilities are going to be deposits. So how do you think about a deposit? Now, on one extreme, isn't it like an overnight loan to the bank? So anytime, any day, you can show up at a bank and take all your money out, right? So in a sense, if everyone did that, the bank would go bust, because all their unrealized losses would have to be realized as they sold them to make investor payments, to meet withdrawals. But in practice, though, I mean, at least speaking for myself, I never go to the bank every day and take out all my money at the same time. So
look how easy it is for them, for the government to be able to implement a limited amount that everyone, I mean, to help avoid this, that there'll be some kind of rule.
So
okay, go ahead.
So in practice, when you have money in a bank, you basically keep it there for some time. In practice, a deposit isn't a overnight liability, it's a term liability. It's just that you don't know what the term is, and banks try really hard to make that term as long as possible, to make that deposit as sticky as possible. And they do things like, let's say, give you good customer service, or maybe try to tie you into their ecosystem by offering credit cards or mortgages or wealth management services and so forth. Kind of like Apple locking into their customers into the Apple ecosystem. And there's a huge, all sorts of ways that they try to lock you in to their bank to make that deposit liability a term loan to the bank. What Silicon Valley Bank did was they basically went to these founders and who could not get loans from anywhere else and said that, hey, we'll give you a loan on the condition that we're your bank. And First Republic then went around and found really rich people and said, we're going to give you really cheap mortgage loans, but on one condition, we're your bank. And those strategies were not successful in trying to make deposits sticky. But usually speaking, just historically, I think banks are pretty successful in making their deposits sticky, if only for the fact that most people just don't care that much about how much interest they receive.
Okay. Do you think that there's a chance that it'll be an idea that there'll be a certain amount, limit the amount that bank customers can withdraw during a certain period? Do you think that's going to go anywhere? There's talk.
No, I don't think the bank. I don't think the banking sector is unhealthy. I think the banking sector is fine. When I look at, and so if they did have deposit limits, I think that's a clumsy way of doing it. I'm not sure it would help, because then everyone would go and get cash out immediately, even if they didn't need it, because they would be afraid they wouldn't be able to withdraw later. Now, just taking a step back, if I look at the banks that failed, Silvergate, First Republic, Signature, Silicon Valley Bank, those are all banks that their client base was heavily speculative tech. We all know that over the past couple of years, speculative tech, crypto imploded, and it seems like they took down banks that heavily depended upon them.
Right. What did you glean out of the? I think it was just a presentation by both Powell and Bernanke. They got together last week, and I don't know who they were addressing, but did you glean anything out of the discussion of their frat party?
So I hear that, and I think for them, for Chair Powell, June hike is not a done deal. So throughout the FOMC, we have 2 voting members come out openly for a June hike: Governor Bowman and voting member Logan of FRB Dallas. Powell not committed. Future Vice Chair Jefferson not committed. So they're going to look at they're going to be, as they say, data dependent. So if we have a hot CPI or a hot NFP print next month, I think June 25 is on the table.
You still like risk here, Joseph, or was
no? I'm really bearish. I'm looking for a 10% correction in the Qs, and for the S&P a little bit less. So I look at the world through the lens of, I think the biggest driver of assets is central bank policy. Now the market, I think, is rates. So the market is still pricing, I think, too big a possibility of rate cuts in the coming months. I think that's completely unwarranted, and so I realize that it looks like the technical picture is good, but when I look across the rate universe, I think I see the rates markets 10-year becoming more aware that rates are going to stay higher for longer. I see the dollar strengthening, and I think that some of the more speculative aspects of the market, some of the like tech, which, well, I think tech equities are usually the last to know. I think they are getting ahead of themselves. I don't think they'll crash, but I think we are due for a correction here.
Yeah, here's Microsoft. So, there's been about, you mentioned the Qs, and the Qs are what, 100 stocks in NASDAQ? Yeah, they're 100. And within the 100, it's mainly, Apple, Microsoft, about 8 of them. And this is the move in Microsoft. Yeah. And Apple knocking at all-time highs. So anyway, look, you buy straw hats in winter, and when everyone's lining up to buy something, sell it to them, right? And people are lining up because a lot of people think a narrative works all the time, and you're a trader too. And your narrative is that public assets will be where money will go. And I brought up Apple, but it doesn't mean that Apple can't pull back to, 150, 160. You could have pullbacks in those areas. And the euro, Joseph, with what's going on now, and the euro finally topped up around that 110. I think that there's a possibility that you could get your area. You see this blue line down here?
Comes 103.
Comes in around, this is where it might stop. But this is a trend line it broke from the highs in 2021. And
has to test that, right?
Yeah, near $1. And I know you didn't ride the gold and silver train. You were looking for cheaper prices.
Yeah,
You think you're going to get them now with the dollar
I
rally?
think so. I think so. Yeah. So
Okay.
listen, broader picture.
Yeah.
I think gold and silver and all of these, I think more tangible assets are okay. But I think that we're at the beginning of a dollar rally. As again, like I mentioned, I view the world through the lens of rates, and I don't like that the market has such a high probability of rate cuts later in the year. I want to see that come out before I feel more comfortable buying risk assets and gold and silver.
Okay. What do you think would be the catalyst for that coming out if it's not going to be the Fed? Could it be the debt ceiling? Then, and let me ask you this, could a debt ceiling problem be great cover for why the economy is going to be lousy next year? Could blame it on Congress. It could be the Republicans will blame the Democrats, and the Democrats will blame the Republicans, and the Fed could say, maybe it wasn't all our policy that we have a weak economy in 2024. If we hadn't have gone through, if we just passed a clean debt ceiling, maybe we wouldn't have been here. It wasn't all us.
So the Fed never blames Congress, but Congress can blame the Fed. So the Fed is kind of like a punching bag, right? It's their
Yeah,
punching
okay.
bag.
All right, okay. So the Fed will take it on the chin if we have a recession next
Yes.
year. Do you think we will next year, Joseph?
Yes, I do. Not this year, but yes, next year I think we will.
Okay, and hard landing?
No,
Soft?
I don't think we'll have a hard landing. It's possible depending on how big of a spending cuts we get. If we have huge spending cuts, I think we could get a hard landing. But
Okay.
I think that's the big variable that I'm not sure how these negotiations would turn out.
Okay.
But broadly speaking, you know, so even though the Fed has hiked overnight rates to 5%, if you look at the really economic sensitive rates, like the 10-year, you know, we're still like 3.75. Inflation is 5%. It doesn't seem like it's the cuts are fully having an impact on the real economy. We see very interest rate sensitive sectors like housing, for example, stabilizing.
They're parabolic, the housing stocks.
Yeah, the home builders are.
Yeah.
So that tells you a lot. It tells you, first of all, that home prices are going to be stable. Why? Because inventory is low. No one wants to sell their old homes. And so that means if you want to buy a home, you got to go to a home builder. Home builders stocks are supported, but also home prices as well, because there's not as much supply. And that kind of takes away a major channel of monetary policy. That means there won't be big construction layoffs because the home builders are doing well. And that also means that there's not going to be a big negative wealth effect because your home prices are not going to go down that much.
Yeah, you know, you think about it, the market's gone up while the 10-year's gone from 330 to 375 and a half. And that's called, they could both go up together for a while with what's called disintermediation, correct? Where risk could go up with yields going up until you get to a tipping point. And what do you think it'll be? 390?
I still think yields 10-year goes above 4% by the end of the year. And I think that will not be good for risk. I don't think we're going to crash, but I do think we correct.
Okay, because this does look like a consolidation before another move up, like a flag or a triangle, which implies another move to the upside. So 390 is what this little formation measured. Over 390, I think it's going to be a little panicky there, don't you?
I think some people, you know, I want to say that, but then over the past few days, we see the 10-year steadily going higher, but we also see like supposedly the more, let's say, interest rate sensitive stocks like techs, they also go higher. So it doesn't seem like that relationship is there at the moment.
Right. That's what in the 87, we had bonds crashing. Okay. Yields were going up, and the market kept blowing off to the upside until there was a tipping point. And then the bonds rallied huge, and you know, we had a crash. So it could last for a while with rates and the market going up, but it does usually reconnect.
Yeah, I think they eventually will. But that's
So
why
what's
I'm
your what's
kind
your
of
last
cautious.
most recent article that you're putting out? And I do appreciate getting your emails and then being able to go to your
Yeah.
site, even
So
though I don't understand, a lot of these things like LCL or R, but you explain them well.
So one thing I'm thinking about right now is just how long do you have to have, how long does high inflation feed into inflation expectations? We've had 2 years of inflation above 5%. Now, eventually that's going to impact how people think of their future inflation. Now, I don't actually know if inflation expectations cause inflation, but I know that the Fed thinks it that way. And that's going to make it more urgent for them to lean more hawkish, because they want to get actual inflation down, because they're afraid that high actual inflation will lead to higher inflation expectations. And I think you're hearing some commentary from Fed people being more concerned about that. So that's another reason why I can see I'm more biased towards a higher for longer stance in rates. That is, again, not fully priced into the market.
Because there are products out there, Joseph, I notice them in my everyday life. Certain products have come back down, like egg prices, but there are certain products that I have a hard time understanding why they're up 30-40% in price. It's almost like it's not because of what the contents are or what it costs to produce them. It almost seems like it's done just because it can be, to raise prices like that. Is that
Yeah,
what you're talking
definitely.
about?
Well, the retailers, they definitely are saying that they feel like they have pricing power, so they're willing to raise prices even though it costs them some volume, because that's how they maximize their profit. So that's definitely happening. The fact is that a lot of industries aren't very competitive. So you have this kind of oligopoly like system where some retailers have a lot more pricing power than you would think.
Okay. All right. Well, Joseph, again, thanks for the clarity. Fed's not going to move. Yields are still going higher, and be careful out there about risk. Maybe it's more about the return of capital than the return on capital, unless you're a trader.
Sounds good.
Right,
Thanks
buddy?
for inviting me, guys.
All right. So everyone, Joseph Yang, follow him at FedGuy12 and go to his website if you want to learn about what Joseph knows. He shares it. You want to take an online course in the Fed, he offers a few of those, and you could find him at fedguy.com. Great to talk to you again, Joseph. We'll catch up in the summer.
Yeah, I'll talk to you guys then. Happy trading.
All right. I hope it's more than 10%.
Well, I'm really short, so I hope so too.
All right.
All right.
Joseph Wang, everybody. Thank you, my trading warrior brother. That's
Bye.
a wrap. That's a wrap, everyone. You could join the team in about 17 minutes, everyone. Have a great day. See you tomorrow. He's a great guy, isn't he? I learned from him, and I wish I could be as calm as him. Anyway, so here's a nervous coach signing off, telling you while I buddy my nails, not to just count your pips, count your blessings. And I'll see you all tomorrow, God willing. Adios.